All right, welcome back, everybody, to another exciting episode of the I Love Annuities podcast. I'm Jeremiah Conger.
And I'm Zach Van Ness, and we are
the
Annuity
Dudes, coming back to you live for another exciting episode. Zach, how's it going out there, man?
Good. I actually just had a frog in my throat there. We were laughing a little bit too much before recording, so had to get acclimated.
It's crazy what can be done these days with AI. Not going to mention what Zach was referring to there, but pretty interesting things of what you can do with AI and being able to manipulate photos and things to make them look the way you want. It's unreal.
Unreal. You're not kidding. How about you? What's new with you, man?
Well, we're doing a lot of new exciting things here at the association. Really getting us set up for the future to really continue building on our mission of creating a better annuity buying experience and helping people entering that new retirement phase make better annuity buying decisions. Again, our mission since day one has always been to educate and provide 100% transparency when it comes to evaluating and comparing the hundreds of annuity products on the independent annuity marketplace. And, that mission has always drove us to continue pursuing improvement to delivering that transparency and education, which ultimately creates trust. So behind the scenes, we're working on a software that will allow consumers to purchase annuities directly online and really truly unveil the curtain of the hundreds of annuity products that are available so that consumers can truly make an informed and educated decision on which one is right for their situation. So we're set to launch that platform in the middle of November. So just about a month away or so, maybe a little less. And we're really excited about that.
Yeah, really pumped. So you think we'd be able to share that towards the end of November on our podcast?
Yeah, that's the goal, is to start using that in these podcast episodes to bring that transparency directly to these episodes for sure.
Awesome.
Zach, I don't know if your microphone's plugged in. It sounds a little echoey. I want to check on that.
Is it?
Yeah, it sounds like the microphone that's being used right now is on your computer versus the mic in front of you.
Yeah.
But anyways, we're excited while he gets that squared away. We're excited to be bringing to you an episode where we will be helping somebody evaluate whether or not they should buy an annuity. So this episode is going to be titled, "You're 60 years old with $500K earmarked and saved for generating retirement income, and you're wondering if you should consider buying an annuity or not." And that today will be the premise of our episode. So we're going to take you through some real life scenarios of different ways annuities could be positioned to help somebody evaluating that circumstance and determining whether or not an annuity is something they should consider. We'll look at the different annuity types and what that 500K premium could generate regarding income and for how long. And then we'll share a unique strategy that we've developed over time here within our organization that we call the bridge and boost strategy, where it's using a combination of different annuity products together to make an overall optimized approach to the equation to, in general, create more income now and into the future. Did you get
How do
that?
I sound now?
Yeah, you sound great.
There we go.
So let's take a look. You're 60 years old, you've worked hard, and you've saved $500K and earmarked that $500K for generating retirement income. Now, just to put the disclaimer out there, this person has more than $500K, but this $500K in question has been compartmentalized to service their retirement income need for their future. And now you're in that situation where you're asking yourself, I've heard things about annuities. Maybe somebody that's bought an annuity in the past. Maybe your parents had annuities when they were in retirement. Or maybe you're new to the game and trying to figure out what's the best approach. There's many different ways to skin a cat, for a lack of better terms, and that's no different when it comes to creating a retirement income plan. But I will tell you, there's only one true way to do that. Do it with guarantees, or leveraging guarantees on your income for life. So that's the question that many people have as they're getting into that retirement phase or nearing it. And that's what we're here to address.
That's right. And with that question in mind, it can really literally shape the next 30 years of life. That could be the difference between running out of money at 75 or living comfortably without stress until 95.
Yeah, and I think that's a key point there, right? Is without stress. I don't want to be stressed when I'm in my golden years, where I
Yeah.
no longer maybe am capable of working or cared to at that point. But I also want to make sure that I can maximize those remaining years with my family and loved ones, or maybe it's traveling or doing the things that we've all aspired to do our whole lives. That's why you work hard. Who in their right mind wants to have to stress about whether or not they're going to have enough income or enough money in general to get them through a long life, a long period? Retirement life, in that span, let's say you retire at 65. If you do live to 95, that's 30 years of planning and money that needs to get there in our bank accounts every month for the rest of our lives up to that point. And if you think about it, like, that's literally longer than some people worked in their life, right? 30 years is a long time. So with that being said, I think it's important to have a plan that gives you peace of mind, clarity, and confidence, and low stress throughout that long term period of time. It's really, really essential. And um, there was a write up that we used in one of our articles a few years back called the just in case retirement. And it's where somebody has saved money for retirement, but they don't have a true plan with guarantees on income. And so what happens is that they pinch pennies every aspect of their life, just in case they live longer, just in case they have a health event down the road, just in case their roof blows off, just in case, the next rainy day event happens. They're scared to spend. And what happens is that puts somebody in a bad position where they don't have a lot of peace of mind. They don't have that good sleep at night, like Zach says. They don't have the sleep at night annuity or the sleep at night solution to their retirement plan. And that's a scary, position to be in. And that's where we really don't want anybody to be in that position. There's a lot of ways to generate retirement income, but there's one way that's far more optimal when it comes to peace of mind and low stress, and that's with the guarantees of an income annuity.
Without a doubt. Yep.
So today, real quick, we're breaking down that exact decision framework to help put you in a better position. And right now, we're going to look at that scenario where, someone's 60 years young, 500K earmarked to generate retirement income, and they're wondering, should they buy an annuity in 2025?
And really, to carry over from what Jeremiah had mentioned, some of the old planning process that had been in place was that general word that we've heard, that 4% rule, right? We've all heard that before. Well, if we look at
Remember old Billy Bangin?
That's right. That's right. I don't know if we've got the sound clip on that anymore.
Yeah, William Bangin, who created the 4% rule, who's still around, and actually I've heard him on a few other podcasts recently talking about the 4% rule and how it holds up today, and it's pretty interesting stuff. But I can tell you that there's better ways to address that equation. His way is a good way, but there's better ways, and that's been proven time and time again through retirement experts, PhD experts for that matter, that have looked at every single way to do this. And the annuity is one of the ways that's a pure optimizer above and beyond what the 4% rule could do.
And there's some questions that come with that, right? So if we take a simplistic approach, and again, using that example, a gentleman who's 60 years young, 500,000 that he's got earmarked towards providing income for the remainder of their life. What's that going to do? Well, if we take that 4%, that's 20,000 a year that we have access to, or $1,667 a month, right? Well, that doesn't eradicate the concern or what may happen in the market and the risk that comes with that, especially as we look at what that timeline may be and having access to that money as we get closer to, there it is, as we get closer to our final years. And how does that affect us? What kind of stress does that create?
Exactly. And the thing about the 4% rule that I look at too is you're managing that on a yearly basis. Like, that's the way that it's structured. Is every year you look at the growth of your portfolio, and then you add an inflationary adjustment to the income you're taking, and you're taking 4% of the account balance the following year, adjusted for inflation, and you're doing that every year. That doesn't get easier. That gets harder as you get older. It gets harder because there's a lot of uncontrollables in the market. There's a lot of unforeseen events that occur over a 30-year period. There's a lot of, different uncharted territories or waters, if you will, since I'm a boater, I always say waters. There's uncharted waters that you may go through that you never went through in the past. And also, quite frankly, that the 4% rule may not have been built upon. There's so many things changing with the financial and economic aspect of our economy and our country, for that matter. I don't know if I would trust myself, and I'm in this business, to continuously be able to monitor and adjust accordingly a 4% withdrawal rate over a 30-year period, because as I age, I know I'm going to slow down. And quite frankly, I don't want to have to do that crap anymore. And that's where the 4% rule is, in my opinion, outdated. It's an old way of addressing it, because back then, this rule was created in the 90s. Interest rates on bonds were double what they are today, or at least significantly higher.
Here, and real quick, keeping that in mind, in the 90s, there was not a time where you could send out, and I'm not trying to get political or anything, but there was not a time where you could send out a tweet, or I guess a post on X, and change the market like that.
100%. Like, the way that the market is so connected now, in that one simple message that can be sent out through the world on any social platform, and then completely, even if it's false, like the narrative they're putting out is false, it can still have an impact on the markets, negative or positive. I don't want anybody having that type of control over my future.
Yeah.
And especially when it comes to financial perspective and income that you need to live on and sustain your lifestyle. So, there's a lot of ways to look at it. That's a really important point there. Like, the way that the world was back in the 90s is a night and day difference of what it is today.
Yep.
And the markets are so emotionally driven by factors that don't even have to be real, but yet it can wreak havoc on the success or failure of your portfolio.
Yep. Without a doubt.
And the other thing too about the 4% rule that I also pay attention to is it doesn't account for human behavior. Like, there's a reason behavioral finance is such a important topic today, is because human psychology and human behavior is still very prevalent. So in other words, you need to be a very, very, very disciplined person to stick to a 4% rule for 30 years. And that means any other variable that comes up, you need to never deviate from that plan.
Mm-hmm.
That's hard. People have a hard time doing that. The nice thing about an annuity approach is it's an autopilot approach. It's done for you automatically, instilling discipline automatically on your retirement plan. Like, talk about an optimizer there, is it's ruling out the failures associated with human behavior and poor decision making, which we know happens. We've done other episodes on this where the the poor timing getting in or getting out of the market because someone's fearful of losing, or maybe they're greedy and fearful of losing out or missing out, the FOMO effect. We've talked about the impact it has on your overall returns in the market if you miss the 10 best days of the market a year, or if you miss the 20 best days of the market a year. The annuity plan is autopilot. It keeps you disciplined from an income perspective to allow you to never have to touch or be forced to touch the rest of your growth assets that are invested in the market. Like, I'm just telling you, like, that's such a big point there that I can't drive home enough.
Yep. Oh, without a doubt. Without a doubt. Yeah. And it brings up a good point. You know, when you look at something like the everyday expenses that are coming in, and then we factor in the uncontrollables, might be something like additional costs that may increase, whether it's housing, healthcare, groceries, inflation, becomes a lot harder to manage when we're trying to stick to that 4% rule or stick to a certain amount that we can only tap into with the ability or the option to take out more.
Exactly. So if you go back using that 4% rule on that same 500K, you mentioned it's going to generate 20,000 a year or 1,667 a month. And then let's assume this person is anticipating having Social Security activated at 62 rather than deferring it, just for this circumstance. And that's going to generate roughly 2,000, maybe 2,400 at best a month. You know, the total income for this person at age 60, planning to retire early, is going to be around 3,500 to 4,000 all in when using just a 4% outdated rule and the Social Security coming in. So the question becomes, is can 500K be enough? Well, that answer is going to differ. It's going to be dependent upon if it's positioned correctly, but it could also not be positioned correctly to then equate to the answer being not nearly enough. And that would be if it's left and exposed unnecessarily to high market risk or low yield bonds, where the 4% rule was based on a 60-40 portfolio between equities and bonds. So that's where annuities now can create predictability and peace of mind while also optimizing, you know, the piece of, you know, the certainty and the clarity, but also the growth assets that are remaining outside of this 500K. It's going to allow those to stay put in the markets. Let's say put it in a blue chip S&P 500 index fund, and you're going to gain all those gains over the 30 years, which will build up a nice nest egg for legacy, can build a nice leisure fund. It can also build up a self-funded for long-term care plan. I mean, that's the real optimizer that the annuity does, is it takes the pressure off of the remaining growth assets so that you can set it and forget it and maximize those funds over the next 30 years.
Mm-hmm. Yeah, exactly. And what we'll do today is we'll actually take a look at some of those examples of how we can get there, how we can utilize an annuity in the path to be successful and potentially outperform that 4% rule.
Yeah. So why don't you go ahead and fire up your screen share, Zach, and then we'll go ahead and take a look at the 3 annuity strategies, if you will, out of the box. Out of the box meaning there's no customization. It's just looking at 3 different products and what they might do in this scenario for someone looking to put a $500,000 investment. So we'll look at multi-year guaranteed annuities first, and we'll talk about some of the pros and cons of putting the 500K there.
Got it. I know when you can see my screen.
Yeah, let's start with MYGAs though, or do you want to start elsewhere?
Let's start there.
Okay. So somebody that's 60 years old looking at 500K and their goal is to generate retirement income. The first thing we could look at is a MYGA. Now, a MYGA stands for a multi-year guaranteed annuity, and it's more equivalent to a bank CD, with the difference being that it's offered by an insurance company, and it normally has a surrender schedule where there are some penalties if you were to exit that contract early. These contracts for MYGAs will range anywhere from 2 to 10 years. There are a few that go beyond that, but not very popular because the offer is not as good. But what you can understand about MYGAs is that they're generally going to offer higher or more competitive fixed rates of return than the same equivalent bank CD of the same tenure. You know, if it's a 2-year MYGA versus a 2-year CD, generally the 2-year MYGA is going to pay more, so on and so forth. So when someone looks at a MYGA, generally these people are looking to grow their money safely. They're looking to not take any risk with it. And that's where a MYGA is very strong because it offers that guaranteed fixed rate of return each year for the duration of the contract. And in addition to that, it offers a guarantee of principal protection. There's no downside risk to the markets. It's not invested in the markets at all. Where someone can utilize this for income is in the situation where maybe they're only looking for income for a shorter period of time. Let's say the term of the contract. So if we're looking at a 5-year MYGA, they may only want income for those 5 years. And the way that they can source that income would be through leveraging the free withdrawal provisions that are built into the contracts or that are available through adding a free withdrawal rider. If it is a rider, there will normally be a small fee to access that free withdrawal provision, and that fee will come off of the fixed rate. So if it's a 5.5% fixed rate without the rider, and to get the rider, it's 15 basis points, then that new rate becomes 5.35% to have that function. But some of these MYGAs have the free withdrawal built in, and if that's something you're interested in, we have the ability to compare all of the available MYGAs on the independent annuity marketplace and ensure that the one you're getting meets that goal of having a free withdrawal provision. Now, if it has a free withdrawal provision, generally they're going to be anywhere from 5 to 10% of the account value each year. Some also only allow for interest only withdrawals. So whether you only want to source income based off the interest earned, that's a possibility. Or maybe you're okay eating into the principal a little bit as long as you know interest is the majority that you're withdrawing. So let's just assume, Zach, that they maybe want to do like a 10% withdrawal. What do you think?
Yeah, let's start there. That'll filter out some results. And assuming, using the example you gave of 5 years, we can scroll down. We'll be able to search by that designated term. So like Jeremiah had mentioned, you can go anywhere between a 2-year term, 3-year term. And if I scroll down even further, we can go out, like you had mentioned, all the way out to 10 years if we want to. But what we'll do is we'll stick to that 5 years as our starting point. And you'll see these carrier ratings associated to that carrier. You can also filter those results based on the criteria that fits your needs and what you're comfortable with.
Yeah, we're product and carrier agnostic. Again, if you're just tuning in and you don't know who we are annuityassociation.com. We're an independent annuity advisory firm. We truly care and advocate for consumer transparency and education, and that's what we're all about. In order to meet our mission of creating a better annuity buying experience and empowering someone to make a more informed and confident decision, we don't believe in just showing you one annuity. We show you hundreds of them. We take you through our very hands-on white glove process of educating you on the available products, which ones are going to align with your goals and objectives. And then once we define that, we can show you the specific annuity types that will meet those goals and objectives, and then help you select within those types the one that might meet your needs the best according to the hundreds that are available. So we're product and carrier agnostic. We don't care which company and product it is, as long as it's the one that we collectively believe is going to put you in the best position to meet your goals.
Yeah, thank you for that. Yeah, and obviously I can scroll down, I can see this information, but like I mentioned, there's a filter that we've got. We've got ways that we can sort this. Ultimately, the goal is that in the time spent, we determine the right outcome, and then we can filter the results based on individual criteria. So in this case, we'll sort based on 5-year term.
And then let's look at a 10-year too, just to see what the income would be for 10 years.
Yep.
Let's say in this scenario, this person's 60. They know they have income coming in from Social Security starting at 62. but maybe they want to defer that Social Security as long as they can. They can leverage a MYGA per se in this scenario to bridge that income gap up until a point where they've maximized their Social Security. So they may want to turn it on at 65, 67, or 70 to be able to do that. So we have MYGAs within those term ranges that could get you there and be that bridge to get you what you need until the Social Security turns on. So you're optimizing the Social Security activation.
Let's taper down. Let's go to maybe somebody's only interested in a carrier that's an A- rating or better. And we can see some different results here. So in this example, what we can do is we can now illustrate and see what these withdrawals would look like. And again, this would be for a designated 5-year term. In this case, Axonic, and that 5-year term is offering a 5.7 compound interest to that account.
All right, let's take a look at the illustration and see how much income's kicking off each year for 5 years.
So prior to seeing what that's providing for the income, just a full disclosure of what this illustration would show and what the earnings would look like. Again, remember, this is compound interest. So in this 5-year term, as we see that 5.7% rate, we can also see the earnings increasing year over year if we don't take those withdrawals. So compounding effect is key to this annuity type and one of the greatest values. But if we do utilize that withdrawal, now we don't have anything to compound on, which is okay, but we can see a different structure there. So 10%, we said?
Yeah.
And this product does not have a free withdrawal option in the first year. So you'll notice we don't have the ability to take a withdrawal year 1. Starting in year 2, we do. So again, we're taking 10% from that premium of $500,000. And we can see how that would affect us year 2, 3, 4, and 5.
So starting in the second year, that withdrawal is going to start at $52,850. And because we're electing to take a 10% free withdrawal, which is above and beyond the interest that's being earned on the account, the annual withdrawal amount will actually go down each subsequent year because there's less money in the account value because we're taking out more, eroding that account value annually. Right. So in year 3, that income goes down to $50,276. Year 4, $47,828, and then year 5, $45,499. So it is giving them an income, but it is going down because of the erosion effect that's taking place on the account value each year. At the end of the 5th year, that $500,000 has reduced to $432,828. So still a way to, get an income stream for a number of years, and get a fair income while doing that. So overall, I think it's a sound strategy if you're just looking for income for a short period of time, and maybe you're trying to bridge the gap between when you retire and when Social Security can turn on. In this case, this person would be deferring or taking an income starting at 61. So in theory, they could go out 5 years from there, or 4. I guess that's another 4 years. So they're at 65. Yeah. So their Social Security now could be activated at 65. But if you wanted to use that same framework, maybe defer the Social Security to 67, you could buy a 7-year MYGA. Right. Or if you wanted to go out to 70, you could buy a 10-year MYGA and still do that. Now, the cons here in doing this is that, the income is not guaranteed for life. So we call it playing the game. We know that even if you defer out to 70, your Social Security in general is not going to be enough to sustain your lifestyle and the essential living expenses associated with it. Social Security was only designed to account for about a third of your total living expenses. Most people can't sustain their life on Social Security alone. So we still know that you're going to need additional income streams to bridge the gap between your essential expenses and the money coming in from Social Security. So the problem with using a MYGA in this scenario is you're still at risk to the inflationary interest rate environment.
Mhm.
In other words, you have inflation going against you, but you also have the interest rate environment going against you potentially as well. So depending on, let's say you did a 10-year MYGA and you lock in a high interest rate today, and your thought is, well, I'll just in 10 years buy another 10-year MYGA and just keep doing that, rinse and repeat. Well, you're exposed now to the interest rate environment, which is directly correlated to the annuity rates. So in this case, you might, for the first 10 years, get a really good rate. But if you're in a low interest rate environment or an ultra low interest rate environment after the first 10 years, and you try to do that strategy again, you're in a situation where you're not going to get as high of an interest rate, and that's going to work against you. So
Yeah.
there's no lifetime guarantee on those. You're also still exposed to the interest rate game, which I'm not a fan of, but everybody's different. And maybe that is a plan that you still want to approach. And that's something that we can help you work through.
Yeah. Yeah. And a great example of that is, if we go back to 2020, 2019, where the rates were insanely low, we were probably double from where we were then on some of those MYGA rates at that time.
We're well above double. I can remember in 2019, the fixed rates were at like 2%.
Yeah, there you go. So
So
something to consider there. And if there's a different strategy, somebody may say, well, I don't want to take out that 10%. Well, if you took the earned interest, again, there's the opportunity there where you can take that earned interest for that designated period of time. So a couple of different ways you can slice it.
I think the MYGA strategy is ideal for someone looking for short-term income.
Yeah.
But if it's really trying to address your retirement income, which is a long-term play, I think a MYGA does not really work well in that scenario unless you have other plans for future income streams. You could do like a bridge and boost with a MYGA potentially, but I think there's other products that would be better at that.
Yeah, I mean, as we've referenced before with the MYGA, its primary intent is safe market growth. We have some options within it. We got some flexibility within it and using its tools, but its primary purpose is that safe market growth.
I agree. So let's go ahead and do the second approach, which would be looking at another annuity type called a SPIA, single premium immediate annuity. It's the oldest form of income annuity there is. The Romans actually paid their military in the form of annua, which was payments for life or payments for a period of time. That's really how a SPIA was invented, was based on that premise. So let's take a look at that. So in this scenario, this annuity is going to be guaranteed for life. It's a simple structure. It is a fully annuitized product. What that means is that by putting in that 500K premium, you're relinquishing control over that 500,000 in exchange for a guaranteed lifetime payment. This payment can be structured for single life, so just for you, or you can do it joint life for you and your spouse. The way that works is that, if something happens to one of the spouses, the income continues on for the rest of the surviving spouse's life. So let's put that same scenario in 500K.
Yep.
And let's just start it out right out of the gate and see how much that'll generate from a monthly lifetime income perspective.
Yeah. So starting income next month.
Yeah.
All right. And monthly income would be, drum roll, a little over 2,800 a month.
All right. So we have Athene comes in number one. It's an A+ rated company at $2,835 a month. This was structured for single life. This is a life only structure as well. So it's going to be guaranteed for that one person. So it'll pay out roughly $2,800 a month. Now, what we do know is that is higher than the 4% rule, is it not, Zach?
Mm-hmm.
That's higher by about $1,220 a month. Yeah. So right there, we've already optimized the scenario, taking the old school 4% rule, and which would generate $20,000 a year or $1,667 a month. And just by rolling that same 500K into a single premium immediate annuity, we just optimized the situation by creating another $12,020 a month in income. or in other words,
Yeah.
on a yearly basis, we're now at $34,020 a year.
Yeah, which would be 6.8% per year instead of that 4%.
Now, the cons to this strategy, again, you are relinquishing control of the principal investment. Some people are okay with that because they earmarked it for that purpose of serving as a lifetime income stream, but other people aren't. The other con would be that there's no inflation protection on this single premium immediate annuity. But what I can tell you, though, is that's okay, because if you're strategically placing the annuity as an optimizer, the way that it's going to optimize is the remaining assets that you have outside of this annuity can now be invested in the markets, and that market account is what serves as your inflation hedge. You don't need the annuity to do it all. You just need the annuity to play its role and what it's good at, and that's giving you the highest out of the gate guaranteed lifetime income stream, and then have the rest of your accounts, market accounts, be your inflation protection, be your inflationary buffer. Why? Because now you're only putting a small amount of pressure on the market accounts to service an inflation adjustment. You're not putting too much pressure, and that's where the gold is. In
Yep.
addition to that, it's just again optimizing the growth element. You're getting more growth because you can take more risk, because you risked off enough to serve as your income foundation, which is what the annuity is doing.
Right.
Not to mention your Social Security also is already inflation adjusted as it is. So you're really only asking your market accounts to keep up with inflation on the annuity side, and that's pretty easily done. All right. So now let's just look at, what an indexed annuity with an income rider would do. Can it beat this SPIA at 3,200 a month, or I'm sorry, 2,835 a month?
Yep. Yeah. So fixed index annuity with an income rider, there to provide a lifetime of income. Similar structure in that sense. However, there's some variables that come with this annuity type, in that keyword that I like to reference is there's some flexibility. So with this, we've got some options that we can consider, some potential growth, and we'll take a look in just raw numbers, just how we compare if we were to take income immediately on a monthly basis on this 500,000, and we are a little bit higher there.
Boom. So that's amazing, right? There's a lot of people out there. One of the biggest misconceptions is that, a SPIA is going to give you the most amount of income. That's not always true. It's not always true. It can be true at times, and those times would be, if the person's a bit older. If this was a 70-year-old, this might be different.
Yeah.
But in this case, at 60, the indexed annuity with the guaranteed lifetime income rider, or what's some people refer to as the GLWB. You hear all these other terms out there. We call them lifetime income riders. But it's higher. The income here right out of the gate. This is an offer from Prudential Life, which is an A+ rated company. Everybody's heard of Prudential, I'm sure. This is their SurePath income. And that guaranteed income right out of the gate per month is $2,956 a month. So that's significantly higher than the 4% rule at $1,667 a month. And it's marginally higher on the SPIA, which was $2,835 a month. So this is another $130 or so a month guaranteed for life. Now, the benefit to going the indexed annuity route versus the SPIA route, in addition to the benefit of having a higher income out of the gate, is that you do not relinquish control over your principal investment. That 500K is now sitting in an account value that you still have control over. If you want to take out 10% of that account value, you can do that. So you have some liquidity there. If you die earlier than anticipated, that money now passes on to a beneficiary that you would designate in the contract. In addition to that, that account value still has the ability to earn interest on a non-guaranteed basis according to how the index crediting strategies perform over time, therefore further sustaining the liquidity benefits, further sustaining the death benefit potential long-term. If this account had, or if this product had a long-term care enhancement offer, then that account value sustainment is even more important because it enables that enhanced income benefit for long-term care to be available long-term when you would need it most. So naturally, this is the product I lean towards because of all these aforementioned benefits. What do you think, Zach?
Yeah, I think the other factor to consider is the fluidity, right? So when we look at these and we understand, okay, well, I can take that income immediately. But if I said, well, Zach, what the heck is going to happen if I didn't want to take it right away? Well, we can defer it out for a longer period of time. And now you have some options where if we wait that extra year, our income increases from that, what was it, 2,900 to 3,193. So some ways that we can utilize these and adjust with, as we know, retirement is not always an exact path. Sometimes there are changes along the way, and we can be fluid with that.
I think that's a great point too, because I just met with a gentleman the other day. He's 63. He wants to retire by 65. And I asked him, I said, well, do you have to retire at 65? And he said, well, no. He's like, I'm a director in my company. I can keep working as long as I probably want to, unless, I got laid off or something. He's like, but I don't see that happening. And there's a difference between wanting to and having to retire. And I said, well, that's good. And I said, well, the reason I ask is, the nice thing about this is that you don't have to know for certain if you're going to retire at 65. You don't need to know that today to buy this annuity. If you do decide that when you get to 65, you're like, you know what, man, I'm still enjoying what I do. I want to keep doing this for a few more years. Or you want to keep working because you want to go ahead and keep deferring Social Security to 70 to maximize that. You have that flexibility and optionality to do that. And the benefit, it just benefits on top of benefits, because this indexed annuity with the guaranteed lifetime income rider contract is going to continue growing that income benefit pool, therefore just further increasing the amount of guaranteed monthly income you're going to receive long term. So in this one for Prudential, it's offering an 8% roll-up rate on the income benefit value. So that means every year that income benefit value, which is what's used to calculate the lifetime income payment, is growing at a guaranteed 8%, not tied to the markets at all. It's completely independent from the market. So as you go through and look at this, Zach, so now he's showing a 3-year deferment. So this 60-year-old decided to wait and activate income at 63, which would be in contract year 4. The income went from $2,985 and increased now to $3,666 a month, guaranteed. And so that continues. And then in this contract, look at that, Zach. That's interesting. The roll-up rate on this Prudential is 8%, but the period is 30 years. So that gives you flexibility to know that if you want to continue deferring the income stream from the annuity, you can do that, and you can capture that guaranteed 8% simple roll-up rate every year for up to 30 years. I mean, that's incredible. So it's like a Swiss Army knife, you can use
it really is. And not to say that this is the one carrier to go with. There's different variables to consider. But in the example being given, just to show as an illustration, hey, we don't have to commit to taking that income immediately. We can look at how that may be affected if we waited some time.
Yeah, and just to show that we truly are product and carrier agnostic, Zach's going to scroll down here on his screen, and you can see all the other options that start to rank at the top.
What we're going to see as I take out SurePath, they're probably not going to be the top option. Yeah, there we go.
Yeah, they're not. Wow, yeah, that's cool. Yep. So actually, Fidelity and Guarantee, after taking out the filter to just show the SurePath, Fidelity and Guarantee comes in number 1, actually at $3,860. So another $200 a month higher than Prudential, based on a 3-year deferral. And then this one offers a 7.2% guaranteed compounded roll-up rate on the income benefit value, and you can defer that for 10 years or up to age 90, which is incredible. So again, it's all about flexibility and optionality. Where this benefits somebody versus a SPIA is that a SPIA is a contract that's set in stone. When you go and buy that SPIA and you say, hey, I'm going to activate it at age 60 or 65, that's it. You can't renege on that. You can't change it.
Yep.
And
Exactly.
whereas the indexed annuity with the income rider, it's flexible and grows with you and for you, which is cool. If you decide, like maybe you intend to activate it at 60, but then things change, like Zach said, retirement's dynamic. Life is dynamic. And you decide you want to wait 5 years, you can do that. There's no penalty. You can wait 10 years. There's no penalty. Actually, it's a benefit because it grows more, guaranteed.
Yep.
Very, really cool. So we know now that in this case of the scenario, 60-year-old, 500,000 immediate income activation, the income's higher than the SPIA, higher than the 4% rule. The cash flow on this one at $2,956 a month, which equates to $35,472 a year on 500,000. That's a cash flow of almost 7.1%. So that same 500K is given a 7.1% of guaranteed income for life, whereas the 4% rule was only giving you 4%, and it's not guaranteed for life contractually.
So you got the 4%. Then we move to the SPIA where we're at 6.8. Now we look at fixed index annuity where we're at 7.1. Does it get any better?
Guaranteed for life, man.
Do we find a way to make this any better?
Well, let's go ahead and break into our tool bag, man. This is where we really care about looking at this from a pure optimization approach. That's our goal, is to put you in the best position we can possibly get you into. And so sometimes that involves being creative. And that's really where I love this business, because I love to be creative and providing the strategies and solutions that can put our clients in a better position near and long term. So what we're going to look at is our proprietary boost and bridge, the boost and bridge strategy, or bridge and boost. I'm sorry. I'm just
Boost,
like bridge and boost strategy. It sounds good the other way too. Boost and bridge, boost and bridge, bridge and boost. And actually, if you think about it, depending on how you structure it, it could be either a bridge and boost, or it could be boost and bridge, because you might put more up front in the first leg than the second. We'll talk about that now. But so what we're going to look at now is how can we improve this situation by leveraging the guarantees of these types of products to put us in a better position to win near and long term. And when I say win, I'm talking about leveraging the guarantees to still get us an income for life, but to get us more juice out of the squeeze, more income, using the same 500K. So we're going to start very basic, but we're going to look at using a boost and bridge strategy, which is going to include using a single premium immediate annuity in combination with a fixed indexed annuity that's deferred. Let's go ahead and take a look at that. Dial it in there, man.
With that, what we're going to do with that single premium immediate annuity, there's a subsect of that, if you will, where that offers a period certain, where we can get income for a designated period of time. Taking a look at that, that's where we use that bridge and boost approach. So for a 10-year period, let's say we take 300,000. Now, well, let's do 250. Let's call it even for now. We can tweak it a little bit later. We take our 250,000 premium, we put half of it to give us 10 years of income. And then we take the other half and we boost it with a fixed index annuity. Now, by taking this approach, we can guarantee exactly what our income will be in a period certain. For that 10-year period, if we start that income next month, our monthly income that we'll get would be $26.33. So granted, a little bit less than what we were just looking at, but it gets us a bridge here into what may come down the road, and question marks maybe around inflation or cost of living adjustments that we may have. So if we use that approach, we've got our 10 years right here. And Jeremiah will jump to that fixed index annuity unless you've got something else to add.
No, let's so just to add a little bit more clarity there. So we're not looking at the SPIA to be a lifetime income. It's just for 10 years. So from age 60 in this case, activating it immediately, and then out servicing our income needs for 10 years only. So at age 70, the SPIA, or the first leg of this two-leg approach, would stop. The income would stop from the SPIA. But that's where we're going to take the other half of that 500,000, dump it into the boost strategy, which is putting it into an indexed annuity. And then we're going to leverage the guarantees on those income rider contracts and leverage them out 10 years. So the SPIA will fall off after the 10th year, and the indexed annuity will pick up on the 10th year, right after the
Exactly.
SPIA is exhausted.
So what we're doing now is we're saying, okay, we've exhausted our 250,000 throughout 10 years. And with our software, we can illustrate and show, okay, what would my income be if I now turned on my fixed index annuity 10 years later, 10 years after I've received that first bucket of income, that bridge. Now we're boost, right? Now we're in that boost mode. So we've got 60, 250, and now our monthly income has gone up to 3570.
So the benefits of this, okay, let me explain. The benefits of this is two main things. First off, we've now kind of in our own way built an inflationary strategy. We started out at 2,600 for the first 10 years in the SPIA, and then starting after the SPIA is exhausted, the indexed annuities activating after 10 years of deferral, and that's going to start paying us a monthly income. Is that the top option there?
Yeah, I had a filter on it. It moved them
So the
out.
top option now is Equitrust at $3,612 a month. So by doing this approach, we've now created more income long term for the rest of your lives. So remember, the SPIA, which is the first phase of this approach, which is the bridge, is servicing for 10 years. And then the indexed annuity with the lifetime income rider activates after that, creating more income for the rest of your life. So that's the first benefit, is now we've created more income long term. In addition to that, where I really believe the added value to be is we just the indexed annuity has had all this time to grow, guaranteed for the income benefit, but it's also had the opportunity to grow on a non-guaranteed basis for the index crediting strategies and how those affect and impact the account value over the 10-year window while you were not touching it. So assuming we had, decent or favorable market conditions for that 10 years, that account value is now higher than your original premium investment. Why does that matter? Well, if you do have a secondary objective of leaving a death benefit long term, you've grown this account over 10 years and didn't touch it. So now that account value only has to last or sustain itself over a smaller window of time. If you started taking income at 60 out of the indexed annuity, it has less probability to sustain a death benefit because of how much income you're taking out early on. So it's got a longer horizon that it has to be sustained for. But by doing this strategy, it's allowing you to have higher probability to leave a death benefit because that account value grew for 10 years, and then you're having less income withdrawals over a shorter period of time. Okay.
Right.
Assuming you live to like age 90, right? I use this exact approach for one of our higher net worth clients. I mean, these people have millions of dollars. But that's one of the biggest misconceptions, is some people think that annuities are only for people with limited access to funds, or limited assets rather. And that's just not the truth. Actually, annuities optimize anybody's portfolio when used correctly. And I don't care how rich or poor you are, everybody wants to optimize and make more money. So I use this exact approach, and these clients of mine, beautiful people, by the way, just a lot of fun to be around, always positive, always happy. They were selling their business. They had a very successful healthcare business, like home healthcare business.
Yeah.
And they sold it, got a buku bucks for it. but wanted to ensure that their income, which they live a pretty lavish lifestyle. I mean, they spend about 250 grand a year just for essentials, if you will. But they wanted a plan that gave them this large amount of guaranteed income. But they also said, we worked hard for this money. We want to be able to pass as much of that on to our children and grandchildren. And that's where I showed them the bridge and boost strategy. And they're in the boost or a bridge phase now, but we deferred it out 10 years. And by being able to show them that it took pressure off that account value on the indexed annuity second phase, it prolonged that account value sustainment to allow them to have higher probability to leave a death benefit, even after taking income streams that large for many years.
Mm-hmm. It's incredible how we can utilize these. And it's just, again, it's the transparency. Let's run these scenarios out with our clients real time, find out which strategy is the best approach. And then from there, we can make decisions. It's not we're going to present to you one option or two options and say, hey, this is the best outcome for you. Don't worry about what's happening in the background. We need to know how our money is working for us. Show me how you're making this happen. And that's really where our value is added.
And then what's also interesting is that with the bridge and boost strategy, maybe you get to that 10th year where you initially anticipated turning on the income from the indexed annuity, but then something else changed. And maybe you had an opportunity to get more income out in another way. Maybe annuity rates got better.
Yep.
You can then take that 10-year annuity that you didn't activate the income, the indexed annuity that you've been deferring for 10 years. And because we're your advisor, we're not going anywhere. We actually audit our clients' accounts every year. That's our guarantee. It's part of our annuity assurance guarantee that when you become a client, we meet with you every year. And if we can improve your situation by either giving you more income or growth potential, depending on what your initial objectives were, we audit your account, we audit the market and see what products are on the market at that time. And if rates improved in that scenario in the 10th year, before you activate your income, we're going to work with you and look at your account and be like, hey, here's the income. Here's how much you could get if you activated it. But let's go ahead and shop that annuity one more time and see if we moved that account value to a new annuity, if that would put you in a better position. And we shop it, we do it. And if it does, then we have that conversation. If it doesn't, then we just activate where you're at.
Yep.
But ultimately, it's giving you that flexibility, right? And the dynamic changing ability. Should your needs or objectives change or opportunities change, we have time to do that.
That's right. Well, hey, I don't mean to leave you hanging, but I got to hop for a meeting.
Cool, man. Hope it goes well. We're going to go ahead and wrap this up. So if you've gotten some value out of this, in the show notes where you're watching this video, there will be some unique links that you can schedule a time to meet with one of our advisors, such as Zach, and get your free annuity discovery session in place to where we can unveil the curtain, show you all the available options, and discuss advanced strategies like this. Or maybe you're not quite ready to meet with somebody, but you want more information. There will be another link where you can request your free annuity report, and then we can go ahead and get that curated for you, customized to your situation, and then go from there. But we appreciate our audience. We appreciate everybody tuning in. This is a really just an awesome experience from our chair, because it allows us to deliver on our mission and providing more education and transparency to ultimately help you make better annuity buying decisions. With that being said, this is Jeremiah Conger.
And I'm Zach Van Ness, and we are the Annuity Dudes.
Signing off.